Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF conference. I'm here with Martin Kremenstein, who's Senior Managing Director, head of NuShares from NUAG. Their first ETF effort. Tell us about it.
Thanks, Tom. Yeah, we've had a really good launch, very happy with it. We came out with our first fund, the NuShares Enhanced Yield Aggregate Bond Fund. We launched that in third quarter. It's had a very, very strong performance over Q4, which is interesting given the rate environment. The strategy, which is designed to extract yield from the portfolio within parameters, really held up well in the rate volatility following the election.
And that's really key, Martin. Advisors have been thinking about rising rates, but they really haven't done anything about it. And now it seems inflation might be kicking in. Is it now the time to be concerned?
Well, I think all advisors need to look at their fixed income book now because they can't just not be in bonds. They have to have a bond allocation. Now they're going to have to look at that bond allocation, see whether it's really working for them in the way that works. And honestly, they've got to look at what is the biggest driver of returns from fixed income. Certainly in the investment grade space, it's yield. It's the coupon. It's what you buy bonds for. And so by buying a product that really allocates towards yield, they can hopefully hope to ride out some of the worst of the rate rise effects while still picking up the return that their investors need.
So get to the essence. How is it different than the Barclays Agg?
So really what you do is you take the Ag universe and then you divide it up into asset classes and duration buckets and credit buckets. So you end up, I think, with 38 different buckets. And then you just tweak the allocations bucket by bucket so that you end up with a slightly different credit profile. So you're a little more in triple Bs, you're a little more in corporates and asset backed, but you're still in the investment grade space. You're still in the the high quality end of the space, but you've picked up extra yield. And at the moment I think it's yielding somewhere around 40 or 50 basis points more than the Ag in terms of yield, which is what you're trying to do. You're not trying to really just smack the ball out of the park every year. You're just trying to eke out extra yield in a safe way.
Right, excellent. Okay, I'm going to do a quick shift. ESG is something that's very popular here at this conference. A lot of companies are talking about it. How are you folks tackling ESG opportunities?
So ESG is something that really goes to the heart of our parent company, TIA. We've been running ESG annuities, I think, since 1990, ESG mutual funds since 1999. We have a big ESG research team. So something that we've been doing on an institutional level in size for a long, long time. And so we tapped into that team to build a series of ETFs. We've launched 5 at the end of last year in the domestic equity space. And really they're trying to bring 2 things to the ESG space. One is the credibility and rigor of our ESG research team, and the other is usability. I think a lot of ESG products have been kind of one-offs. It's like, here's my ESG fund, and the advisors got the mandate to run money in a responsible investing way, and they're like, okay, I have this fund, what do I do with it? Here we're trying to make the ESG part of the core asset allocation. So we started with essentially your main building blocks, so your large value, large growth, mid value, mid growth, and small cap, so that if a client says to the advisor, all right, here, I want you to manage the money in a responsible way, or responsible investing principles, they can say, all right, well, it's the same asset allocation, but I'm using the ESG funds to do it. So they're not compromising on their asset allocation.
Briefly, socially responsible investing's been around for a long time. Not many people have been able to make it keep in line with the benchmarks. Do you think with these smart beta strategies, we're going to be able to do this going forward?
So they've been designed to actually track the benchmarks very, very closely. The idea is to allow investors and advisors to get the ESG overlay without sacrificing performance. And that's really what we're looking to do. Beyond that, I mean, our research has shown that our return benefits to an SRI or ESG overlay, and it particularly comes out on the value side. And so maybe we'll see that going forward, but ultimately we're trying to essentially allow you to get involved in ESG and invest in a responsible way without sacrificing performance.
Excellent. Martin, as always, great seeing you.
Thank you.